Dr. Drollas does not need much introduction, only a couple of words. Dr. Drollas, he worked, and this is very, very important, joined the Global Energy Studies, the think tank founded by the Sheikh Yamani. And also he had a position of director with BP as econometrician, if that is the right pronunciation. And I've seen a few of your presentation, and you also like to be introduced, because that's what you are, an oilman. Correct. So, Dr. Drollas, the floor is yours.
Thank you, Francesco. I would like to thank the organizers for inviting me. It's the first time I've come to Naples since I was a child, some 60 years ago. So it's better late than never, I'd say, and I hope we'll do it again. Salvatore gave a very interesting presentation, but a very provocative one, and it almost tempted me to leave my own presentation completely, because you will get the presentation afterwards and go into the questions he raised. Maybe I'll do a bit of both. So the subject that I have, and of course Mr. Salerno, the talented Mr. Salerno, has covered quite a lot of the issues, so I don't want to tie with that. I just want to enhance some of the points. But the story now at the moment is, of course, that Saudi Arabia has blinked first. Mr. Salerno gave us a very good overview of the battle, if you like, between the shale oil producers, the tight oil producers, and the OPEC producers led by Saudi Arabia. We had a good picture of that. I'd like to just maybe enhance some points. And then I'll go into some details to help you understand better the issue. Just a quick look at the long-run oil prices. I have here changed the picture from just the nominal prices of oil into real terms, and here I've changed it by including both the rate of exchange of the dollar against all other currencies and, of course, world inflation. It changes the picture quite dramatically. As you can see, the blue line represents the real price of oil, and some time ago, back in the 1980s, early 80s, the price of oil was at $250, $2015. So now the price of oil is much, much lower than it used to be in those days, just to bear in mind. So I think we've gone through the current oil price situation. It's a battle between the two forces we see. And the devil I put up there is in the detail, because in November in Vienna, OPEC has to agree some hard facts. They have to agree on quotas. And the question is how to do that. And I'm afraid there will be a lot of trouble in trying to agree that. I will have to disagree with Salvatore that the stock positions in the world hold the key to the oil price. Demand and supply are only part of the picture, and we can develop this in the discussion. You must have, in order to have full equilibrium in the oil price, in the oil market, and prices stable, you need two disequilibria to be ended. One is the demand supply, but that's not enough. You need to have stock disequilibrium, inventory disequilibrium. Stocks rise and fall over time, but what changes the price of oil from day to day is the desired stocks, how much inventory the holders of inventory want to have at any time. And the futures market comes in by helping to determine the amount of stock. For example, let's take the current situation. What happened? There was a meeting in Algiers. They decided to restrict output. They didn't say how, they didn't say when, they didn't say who, but they decided they will do that sometime in the future. The futures market, which reacts very quickly, rapidly to news, decided to start buying futures 1, 2, 3 months ahead. They raised the futures price, and what happened next was what we call the transmission mechanism, how that connects the futures market with the spot market, the cargo market that you carry around in your ships. So what happens, the futures price rises 2 months ahead, say, and it develops a gap between the spot prices and the futures price. That gap is exploited by those who do what is known as cash and carry hedging. They buy in the physical market crude oil, and they store it either in a tank on land or in a vessel, by using your vessels to store it, and simultaneously they sell futures. So what that does is to bring the discrepancy down a bit. The futures price drops a little bit from where it was, the spot price rises, and there is some kind of temporary equilibrium. This, I think, is the way, and I've studied it for many years, how there's a connection between the futures market and the spot. The futures market is very important because it's a very fluid market, very liquid market, billions of dollars are played, and it's a price determination system. It's the most efficient system we have. Before that, we had the oil companies managing the market by controlling the crude that's leaving the Gulf, and they had the internal systems to handle the crude oil. So it was a different system. There was a spot market, but it was very small percentage. 5% of the crude traded before 1980 was in the spot market. But now it's the opposite. There are huge movements, and the main ones are in the financial markets. I just wanted to make these points. If you want, we can go into greater detail. But let's get to Saudi Arabia, and Saudi Arabia is the theme here. Saudi Arabia blinked first. I would like you to pay attention to this graph, which shows the fiscal surpluses and deficits over a long period of time from the 1970s. Saudi Arabia in the 70s had a long period in the 80s and the early 90s of deficits, but they were very small in comparison with what they faced in 2014 and 15. You can see there the huge red columns, which are not getting much smaller. 2016, it's a little bit less, but it'll still be around $60 billion. And in 2017, by my estimation, it'll be a little bit less, but they are very large deficits. And Saudi Arabia could not really stand anymore the pressure that it itself, the country, created by deciding to face the shale oil producers. So this really is the key behind what happened very recently. The Saudis have lost about $137 billion of their net foreign assets. They borrowed at the same time $26 billion last year domestically in Saudi Arabia. And this April, they issued $10 billion of a syndicated loan. They arranged with banks a syndicated loan of $10 billion. And now, very recently, a few days ago, on the 19th of October, they arranged the largest bond issue of any emerging market, surpassing Argentina's bond issue of $16.5 billion. The Saudis issued $17.5 billion. So there is no doubt that Saudi Arabia is suffering the changes in their economy that they want to bring into effect will take too long. So the pressure on the kingdom to deal with this matter was so severe that they decided enough is enough. And this is the background to where we are today. The price, of course, through the futures markets went up from $45 to $50, roughly 51 today for Brent. And the question, of course, is what happens next? As I said earlier, they are meeting in Vienna on the 30th of November, and they have a very big task ahead on how to manage this new kind of system which they had before of trying to manage output. So whether they manage to hammer out a plausible and therefore viable system in Vienna is the issue. As you can see there, I have in red, I say difficult. It's difficult. Now, even if they agree to some kind of sharing of the production cuts, will they implement it? Difficult. Once they implement it, let's say all goes well, they usually typically start to leak oil, because as the price rises, some members are tempted to produce more. And of course, the problem with cartels is that it's called the free rider problem. If someone else can cut, and if you can increase your output, you gain far more than they lose, far more. So there's a temptation to do so, and I'm sure that it'll happen. So the response, of course, of the US to what will happen depends on their price, on their costs of production, etc., as you can imagine. So I'm not very optimistic that they're going to achieve much. Let us go to this to show us what happens in the Permian Basin. The wells, if you look right at the right-hand side of this graph, which shows you the connection between the price of oil in brown and the blue, the light blue line, where these depict the wells drilled in the Permian Basin in Texas. You can see right at the end, as the price of oil rose, the number of wells drilled rose as well. And that is a natural reaction in the United States. They're very efficient. They respond quickly to price for incentives. I've got quite a few details here about fracking and how it started, etc. What I'd like to bring your attention to is this line I'm showing here. The well decline rates in the shale oil wells are very rapid. So the production rises swiftly, and then it falls within 2 or 3 months. So they have to re-drill again. But those decline rates, which were 90% in 2006, they dropped to 31% in 2012, and to 18% in 2016. The efficiency gains are tremendous in the shale formations. They can drill 3 or 4 wells now from one pad, whereas before they would just drill 1 well, and sometimes they can drill 6 wells. So this has been a tremendous change, and it's happened very rapidly. Average well productivity has risen 5-fold in the Permian Basin since 2012. Of the 3,900 wells drilled but uncompleted, 90% are profitable, according to Rystad Energy, at $50 a barrel. So you can see that the response can be very rapid, and it's already happening. So Saudi Arabia has got a problem here. These are the well declines you can see I mentioned before. And this is important, this particular graph, to give you an idea of the pressure on OPEC. From 2014 onwards, the decline in the fully built-up costs, you can see them there. In the Permian Basin, they've come down to $33, $38. In Niobrara, which is up in the Bakken in North Dakota, the falls are down to $35 a barrel fully built-up costs. And Eagle Ford is $39. The Niobrara formation is in Colorado, I beg your pardon. The Bakken is North Dakota, $32. You can see what's going on. So let me go to this problem. And here I'm coming slowly to the end of what I have to say. The problem OPEC has is how to share the cuts in production. And I've done an experiment here. I've excluded Iran, as Ugo said before. They've agreed to exclude Iran, Libya, and Nigeria. So I've taken them out of the equation, and I've shared the production cuts according to the shares these countries had in November 2016. It's a projection slightly, but it's quite realistic. And as you can see there, the price of oil, according to my simulations, doesn't rise enough to help those who cut production, resulting in declines in revenue for all those countries apart from the 3 countries excluded. You can see there that those gain. Why? Because they increase their production, whereas all the others cut production. And Saudi Arabia, on this simulation, is likely to lose $9 billion. They want to increase the revenues, and they're going to probably face a reduction. So is it all worth it? There will be leakages, there will be arguments, and the thing will eventually collapse. And on all occasions, of course, the shale oil will carry on gaining momentum. So we are faced, for the good news for the ship owners, by the way, very good news for you that the price of oil, and of course fuel oil, which you depend on, and marine gas oil, will stay, in my opinion, quite low. I've got a graph here for you in the shipping business. Here's my prediction of West Mediterranean fuel oil, since we're in Italy. And you can see the connection between the actual and predicted from this model is below, the blue line against the orange line. And then you have to predict the price of Brent, which I do, the dotted line. And you can see how there will be a rise in the price of fuel oil, but it won't exceed $300 a ton. And that is if all goes well. That is if OPEC succeeds in its objectives, which I don't think will happen. So we're looking at fuel oil prices in the $250 per ton region as far as the eye can see, not even as optimistic as I show in this graph. So let me go right to the end and my concluding remarks. The Saudis remain in a difficult position. If they manage to cut output, as I said, US shale oil is most likely to take off again, and it's already starting. If they continue to fight for market share, they will have to change drastically their spending habits. They have decreased salaries in the kingdom, they have decreased subsidies, they are trying their best, but these things take time. And I do not think the Saudis really have the political momentum within the kingdom to be able to effect these dramatic changes to their society. Fracking, as we said earlier, you saw the examples I gave, has been the game changer. We all know that. There's nothing new there, but it's gaining momentum again. The changes are continuing. Growing oil demand in the future could help rebalance the market, but the trouble with that is that the environmentalists, as we know, are on a mission to reduce the use of hydrocarbons everywhere. So that is a problem. And on this point, I'd like to, and I'm finishing now, to say one thing or two maybe on the problems that we have with environmentalism. Everyone thinks it's a great thing, and of course it is in theory, but of course it comes with a cost. And the cost in Europe has been very high. I do not know whether you are familiar with some of the numbers. To give you an example, this is the price of electricity used by industry. And in the United States, where fracking occurred, and it's a free economy, and they haven't had very many environmental problems, or they have, but they haven't dealt with it like they have in Europe. And now the price of electricity for industry in the United States is, have a guess, but I'll give you a hint, 6.5 cents per kilowatt hour. 6.5 cents, US cents. The equivalent in Germany is 22 cents per kilowatt hour. This is for industry. Italy, where we are, of course, 19.8 cents per kilowatt hour. Denmark, which has a lot of wind power, 30 cents per kilowatt hour. And France, 13. Why? Because they have a lot of nuclear power. So the thing to bear in mind is that environmentalism is fine, but it comes at a big cost. And the cost to industry is severe. And in the United Kingdom, where I live, the steel industry has now almost crashed out of existence because electricity costs have been very high. And the steel industry is a big user of electricity. So this is a word of warning, if you like. So my final remark is that oil and gas prices are not likely to stray far from the current levels for the next few years. But later on, who knows, but at least for the time being, there is a bit of relief for the shipping industry, according to my view. And let me finish with a quote, a reminder. This is from Scott Fitzgerald, the first line of the concluding line of his famous novel, The Great Gatsby. So we beat on, and it's a nautical allusion here, boats against the current, borne back ceaselessly into the past. So we always have to fight to move forward. Thank you very much.